Greetings, traveler. I am but a humble servant of the mountain, yet the winds of finance now carry as much force as any storm over the peaks. Today, we contemplate the great flow, how the Federal Reserve's decision to cut interest rates, a mere stroke of the brush in the halls of power, can ripple through the tranquil waters of the economy, touching the volatile shores of the stock and crypto markets. When the cost of borrowing, the interest rate, is lowered, it is as if the water gates are opened. Money flows more freely. Companies find it cheaper to expand, to invest, and to hire. This injection of liquidity often acts as a potent elixir for the stock market, encouraging investors to seek higher returns in riskier assets, driving valuations higher. We have seen this pattern repeat throughout history, from the late 90s to the turbulence of the 2008 crisis and the swift recovery after the 2020 health crisis. The stock market, like a responsive mountain echo, often anticipates and reacts to this stimulus with upward movement. The crypto markets, however, are a different animal, a newer, more untamed spirit. When interest rates are low and the traditional dollar yields less return, investors look for alternatives that offer exponential growth. Bitcoin and the wider crypto ecosystem thrive in this risk-on environment. They are seen as the ultimate store of value against the erosion of fiat currency value. Therefore, a prolonged cycle of rate cuts tends to fuel the fervor in the crypto space, often magnifying the gains seen in the traditional stock market, although with much greater volatility. By looking back at the scrolls of financial history, we see a crucial distinction. The market's reaction depends on the reason for the cut. A cut made to preempt a recession will be received differently than a cut made in the midst of a crisis. However, the overarching correlation remains. Easier money typically elevates asset prices across the board. The long-term trajectory is influenced by this cycle of expansion and contraction. This is not financial advice. Please do your own research